Horowitz from Equity Warehouse. Welcome back to a live episode of the Real Estate Reserve podcast. We're live with you going on a little after 10 o'clock on Wednesday, beautiful Wednesday, May 15th. If you're tuning in live, we certainly appreciate all the support. If you have any questions, comments, you just want to shoot the shit with us, feel free to do so on any platform that you are watching or listening to. We're on YouTube, Facebook, LinkedIn, Twitter, everything that this dandy software StreamYard can syndicate us on. We're on there live. We're going to be talking about Q1 market trends, some mastermind groups that Ian and I just attended, and controlling our own capital, which has been a very, very hot topic. So looking forward to this conversation. What's up with you, Ian?
Nothing, man. I'm trying to go old school. Remember how we did this when we did these live? I'm trying to get all the shares going. But no, I'm excited to do one like this. It's been a while, so it should be fun. With that being said, I'm excited to see what we're going to talk about, mostly Q1 market trends. My audio is shit, like usual.
You have your intern in the office right behind you hiding, so get him to help you with your audio.
I don't know what's going on, but we did fix – the good news is we did fix my camera. So I'll work on fixing my audio while you complete the intro.
Well, the audio is pretty damn important. So whatever. That's what happens when you do live shows. It's not a big deal. You freaking make it work. Movie Shock, hello to you as well. Hope you're well. If you have any questions related to anything in this episode, feel free to reach out while we're live. We typically go for about 30 minutes or so. So happy to be of assistance. So let's talk about Q1 market trends. I'll kind of go over some things that we're seeing internally. I'm sure Ian's got some things internally that he's seeing as well. Most of the stuff that we do is either investment, residential, or commercial stuff. Inside our lending portfolio, typically we're lending on about 70% of our portfolio is fix and flip, lending on investment residential properties, things like that. But we also lend on a good bit of commercial assets, apartment buildings, retail, office, some self-storage, some light industrial, some things like that, mixed use. So we do kind of, run the gamut of a lot of different asset classes and have some perspective on all of them. One of the things that I have seen is the liquidity of capital in this space, and there's less liquidity and the cost of capital is more expensive, which obviously has to be taken into consideration. You could be going to a bank, you could be going to an institutional back lender, you could be going to a private lender, a hard money lender. And typically, around the board on the residential side, cost of capital is about double digits, right? It was cheaper, pre-October 2022, and then continued to rise as so. Now, that's being said, that doesn't necessarily mean you can't go to your bank and get some sort of real estate investment loan and get something in the 7% or 8% range. That does exist, but it is challenging, to do so. And, the game of speed takes into consideration when you're buying real estate. So, banking, or banks might not be the best option, although they are an option. So you're down to institutional back lender, private lender, hard money lender, and typically it's double-digit rates of return. Does that scare me? Does that scare a lot of sophisticated real estate investors? No. You just need to adjust your buy price to make sure you make your money when you buy on real estate, and you want to make sure you're still getting at good numbers. We're still seeing very, very good opportunities for fix and flippers that are buying properties and using our funds to do so. And our funds are 12.99 and 3 points, right? So it's not the cheapest capital, although to be honest, it's not much more expensive than a lot of other capital that's available in the space today. That being said, a lot of sophisticated real estate investors that we work with day in, day out are still buying good projects, right? They're not overpaying for stuff. There's not huge bidding wars for stuff, but they're buying projects and they're still able to make their 10 to 20% margins. Ideally, everyone wants to make 20% on a fix and flip deal based off costs. Yeah, that's hard to find. Not that it doesn't exist, but, slightly lower, is still kind of going. So at least on the residential side, that's what we're seeing internally.
Yeah. And I would say on our side of the things, excuse me, is, we're getting ready to sell some assets. We're looking at purchasing some assets, trying to find new opportunities. It's been real interesting. A lot of it does revolve around capital, and what does capital look like? And we're not talking about just controlling our own capital, but we're talking about borrowing. What is that? How's that affecting the marketplace? I think in the single family space, people are still bullish, because it's just an affordability thing. Hey, what can I afford? I have $1,000 a month or $2,000 a month to pay a mortgage. What does that buy me? I have limited money down. So that market's not changing. But in the investment side of things, we're seeing a slowdown. We've been selling off some of our assets, assets that don't serve us in the same way. We've talked a lot about the 80-20 rule before. Assets that just don't serve us in the same way, and looking at selling them off. And on the investment side, there is some sluggish. It's a little sluggish. It happens. I think cost of capital is a big piece of that. In the commercial space, we've had some opportunities to sell some of our commercial assets, and as they come up and listing them, there's not a floodgate of people trying to buy, which I'm not surprised by. But it'll be interesting to follow along what happens and see, will they trade? Are they going to transact? I think they will. I'll be interested to see how much of a discount comes up, if any at all. But I do believe there's going to be some sort of negotiating. Are we going to get exact list price? Probably not, but we're bullish on our pricing, and we need to meet that bid ask and see where the markets meet. So we're along for the ride. As we get real-time data, we'll do a couple more of these live shows and share them with everybody, because this is quasi like our mastermind, to get out here and talk and share the information. So that's what we're doing, and we'll report back what we find as things come up.
So I think a lot of real estate investors have the mindset that they're going to just hold their assets forever, and it's like, oh, this is going to, this cash flow is going to pay for my kid's education, or this cash flow is going to cover this or that as soon as I get this free and clear. And I think a lot of folks potentially get that wrong, and not that that's not a good approach to start with, but typically I feel like a lot of real estate investors will outgrow their portfolio or outgrow their assets, right? Like, think about the first deal that you ever purchased. You purchased the deal that was in the price point that you could afford, the price point that you could wrap your brain around, that, hey, even if this thing completely goes to crap, like, I'm still going to be okay. You bought something that was in, a place that, you had resources in. You bought something that you were happy with the cash flow that it potentially could have spit out. But again, that is limited on what typically you're capable of doing, right? You buy a property for $100,000 and spits out a few $100s a month. That's great. But like, in 10 years from now, is that really what you want? Even when it appreciates and things like that? It might be, but I think, Ian selling a lot of his assets and us selling some of our assets a few years ago and kind of upping our game to buying bigger and better assets. Like, let's be honest, if you have $100,000 property and it doubles in value, or, you have a great cycle and it triples or quadruples in value, you go from $100,000 to $400,000. Great. Pretty damn good for one asset. Now, let's say it's $1 million asset, and it doubles, triples, quadruples. Now you got $4 million. Velocity of capital, velocity of money, velocity of equity. That's what it's about. And I think that's why a lot of people up their assets. And also keep in mind, like, cycles go up and down. If you buy at the bottom and you potentially, if timing markets, who knows where we're at in the market right now, but then you sell at a premium, right? Like, it's hard to get back to that point again. Yes, if you look over the life expectancy of an asset, let's say it's 50 years, right? Chances are, if you bought an asset, at any point, it's going to be worth more than 50 years from now. But that being said, if instead of having this kind of like slow and steady trajectory, you could have a major trajectory, then more major trajectory, major trajectory. And instead of like having one property worth, a few $100,000 free and clear, you could have dozens of properties, instead. So, as we interview a lot of people on this podcast, especially like tenured real estate investors that have been in the game long enough and they're in circles with very high net worth individuals, they all do the same thing. There's always a time to buy and there's always a time to sell. So I think if you're in that spot where, hey, I'm looking to just acquire a certain amount of rental properties and then I'm good and then I can retire, I don't disagree with that. Like, I think that could be a good vehicle, but that might not necessarily be the end. I think there's always more and more and more room. Ian and I have lots of conversations with him because here's the thing. If the deal isn't performing and you're tying up a ton of equity, quote unquote equity, like what's the point? Like, let's say you have $1 million property and you get out like whatever, a few $1,000s a month. And let's say $1 million in equity, right? And you're getting out like, a few $1,000s from it. Like, do the math. You're making like a few percent return. If you're an active investor, you should be superseding 20 or 10, 20, 30, 40, 50, 100% rate of return if you're actively doing this. And if you're a passive investor, you still should be getting 10, a double-digit return on these investments. So I think it's one thing that not a lot of people think. And I look at portfolios all the time for real estate investors, and I'm like, yo, you got millions and millions and millions of dollars in equity in these buildings, in these properties, in this portfolio, and it's not that impressive what it's spitting out to you monthly. There's a better way to do so, and maybe you sell those properties or you tap that equity and you start buying other stuff and you start improving into better asset classes.
Yeah, and I think that goes side by side with the operational drag. If there's income coming out and it doesn't cost you much brain power, then you might be fine with it. But if the goal is to continue to use these as stepping stones to get to the next level, you need to consider selling. I mean, we fell into that loophole of, we're going to own everything forever and never sell anything. But then you start looking at real estate and you're like, wait a second, I'm making $300 a month cash flow on a good year on a single family property, praying to God nothing goes wrong and my turnover costs aren't insane. Great. But then you're sitting on $50,000, $60,000, $70,000 of equity. You're like, well, wait a second, $3,600 on $60,000 of equity is stupid. Like, I wouldn't do that deal. It's less than 10%. Like, I know we can redeploy at 10% or better, so we should sell. So those are just considerations we've been navigating. But, if I couldn't talk to a group of people, share our experiences, I don't know that I would have ever gotten to this end conversation. This is a culmination of us learning in real time, but also resonating with other people's messages, learning from other people's experiences that we've talked to across this nation that operate real estate at a much higher level. I think there's a fine line between being an owner operator and just being someone who's continually flip to get what they want. And there's a structured way to do this. And what I would say is, once you have a sizable mass, then you need to look and re-underwrite your portfolio all the time. I was talking with a guy one time, a friend of mine. He invests in real estate. He's used to work at Johnson & Johnson as a CFO. And we were talking. He's like, well, you re-underwrite your portfolio all the time. I said, well, what are you talking about? He's like, well, you like recast your underwriting all the time and like understand what it's producing. I'm like, well, why would you do that? But that's where we really started to learn and understand velocity of capital. And that's been within the last few years. I mean, look, we have a sizable portfolio, but there's always times to consider and understand what the next step is. And I think we're navigating that in real time. And maybe, you could sit here and fight me and say, this is not the best time to sell, but honestly, who cares, right? There's a dollar to be made on both sides of the coin. If we're selling something today, there's something equally as good to buy. You just got to work a little bit harder to find it, and you got to work a little bit harder to sell it. And that's what we're willing to do right now.
Yeah. And listen, assets do reach capacity, right? Does that think about this. Like, you could go from, 90% growth in an asset, and it could take you the rest of your life or another 10 or 20 years to go from that 90% to 100% growth.
Yep.
Right. So again, that might be the case. That might not be the case. Like, we could all look back and be like, hey, my parents' property that my parents should have never sold that property when we were kids because, they paid $50,000 for it and now it's worth $500,000 for it and it 10x. Might be true, but it could have also got them into better investments that could be worth 100x at this point. So it's kind of all relative. All right. So, I think that's a common topic, and I think it's very relevant right now, especially for a lot of real estate investors that got in over the last 10 years or plus, and they've got a lot of equity in their properties and they're not sure if they should keep them or sell them. Let's talk a little bit about mastermind groups. If anybody's, watching live, I'm going to comment real quick. Are you in a mastermind group? And if so, which one? Always curious to know. I'll kind of tell you the transition and the evolution of mastermind groups for myself. And I think Ian actually has a very similar experience. You're always looking for what mastermind group works best for you. Like, should you be in a mastermind group? 110%. Like 100%. Like, you have to be in a mastermind group. It's the only way to kind of level up and grow and be around like-minded people. And not only in your small sphere circle, in your, city, town, county, state, region, but you can have nationwide exposure, and things on different areas of the country work very, very differently. The fundamentals are the same, but people have different experiences and they try different things and things like that. So it's imperative in order to do so. But I do think that you kind of have to, what's the word? Kind of create it based on you and where you're at inside your business and your experience and what you want out of it, right? Like, there's different things. Typically, you outgrow mastermind groups, you outgrow business coaches, you outgrow consultants, you outgrow things, depending on where you're at, and you usually have great results in that time. But then you potentially, outgrow it. I've been in lots of different groups over the years. I've been in mastermind groups for real estate investing. I've been in mastermind groups for just marketing, stuff. I've been in mastermind groups for a lot of different, lot of different experiences that I needed at that time, right? Like, if you're in a certain phase in your business and you're like, hey, I'm in a growth phase right now, I have a really good operation, it's me and my spouse, or it's me and my partner, and we're trying to grow, it might be time to join some sort of business growth mastermind group that doesn't even have anything to do with real estate investing, right? You're meeting other business owners to help you scale up, hire employees, create comp plans, do more marketing campaigns, things like that. The current group that I'm in, I actually run because it's a private lenders mastermind group, because I always felt that there was a need for it. So out of necessity, my business partner Chris and I started this private lending mastermind group a few years ago because they didn't have it. And that's where we were inside our business, where I want to see what the big heavy hitters that are using only private capital, not institutional capital, because that's not the game, our game. Like, who's only using private capital at a high level, deploying a lot of their own money or deploying a lot of friends and family money into a fund or things like that, similar to us, to see what they're doing. And because it didn't exist, it made sense to be proactive to grow one. And I think, Ian's got a similar experience to that.
Yeah, I wasn't a part of many masterminds, and I did get thrusted into it as we started to learn the self-storage space. Maybe some of it was us seeking and learning, and it was fun to meet new people. I've built lifelong friendships out of that. I've participated in a few subgroups out of there. And what you find is you enjoy the conversations. You enjoy learning how other people are doing it. I get a lot out of learning how other people are doing things in all different asset classes and all different industry types. And that's what resonates a lot with me. So that being said, I left the one group that I was a part of, and everyone's like, well, what are you going to join? I'm like, I'm not joining anything, because like there's the education piece and then there's the execution piece. And I felt like I was being overeducated and not executing enough, and wanted to get back to executing and then go back and educate. And in that time frame, I similarly decided to go out and start our own group, because I felt like the group that I was a part of was missing the top, people flowing out of the top, looking for the next level, business acumen, life acumen, health type stuff, other asset classes. Like, where do we go besides just self-storage? Because Jason said it a lot. These are all just cogs that are widgets that go in the top and come out the bottom, and it's all the same stuff. Just how do you want to do it? So for us, the group that I'm a part of is a mastermind that we've created, that we want to be a part of, and that we wanted to surround ourselves and control the people that we're surrounding ourselves with. That's what's important. We want to put good information, right? It's just like I'm not like a health freak or anything, but the type of food you put in your body or the oil you put in your car, it's the same thing with the people you put around you. You want to put the right people around you that are going to help you float your boat and make you a better person. And yes, they're going to challenge you on ideas, but in the same sense, when they challenge you because they think somewhat similarly to you. However, they might operate just a little bit different. And I think that's the importance of a group, having the right like-minded individuals around you that are going to challenge you. If Jason had a group full of institutional capital lenders, he would get no value out of that because they'd always be challenging his business in the wrong way, and he would never get anywhere. So with that being said, that's why we ended up creating our own group, and it's been really fun and exciting watching it grow as we're starting to formalize it and take it to the next level.
Yeah, exactly. So I challenge you to just figure out who you are and what group you should be a part of. And again, it doesn't have to be, if you're a real estate investor or self-storage investor, it doesn't have to be in the self-storage niche. It can be whatever kind of your growth, your game plan is. There's a lot of very, very good mastermind groups out there that have nothing to do with business or nothing to do with real estate investing, I should say.
Yeah. And we're actually, so like one thing that happened to me was I started to feel, so I left the one group and then we started a storage group. But then I almost felt like a fraud because it was like, well, I enjoy self-storage. I enjoy industrial. I enjoy development. I enjoy learning about, and operating multifamily properties. Like I wanted to be able to talk about all that and people not challenge me all the time and be like, why are you doing this? Why are you doing that? Why are you doing this? Why are you doing that? Because you're only locked into one thing. We're locked into multiple things. And we want to learn about multiple things. And yeah, we were hyper-focused for a very long time, but now we have the ability and wherewithal to operate in different spaces. So the group that we've recreated is about all of commercial real estate, not just self-storage. Self-storage is a piece in this commercial real estate asset class that we're operating in. And actually, I just recently put a post up inside of our group asking for people to help us rebrand it. It's been really interesting to see what names have come across the desk. I think there's something there. My favorite one so far has been big building buyers. I don't know why it resonates with me. I can see all kind of, I can see all kind of fun merch around it. But either way, there's been some like really good ones, and it's been interesting to see. But you guys will see it as Self-Storage Secrets out there right now, a part of the LFG collective. But at some point we're going to rebrand and get this thing cleaned up. I'm looking for some help on some rebranding. We'll get the link in the show notes to our mastermind and Jason's masterminds. Mine personally, I am looking to rebrand and try to figure it out. So looking for any help if you guys got some. I'm not a marketing genius by any means.
Yeah. But again, you set this up based on what you wanted because there was a hole in the market. You couldn't find the one that you wanted to. So you base it off yours. I mean, my group, everybody in the world you should scale this. You could scale this. There's a huge opportunity. There's a hole in the market. It's like, hey, listen, I'm a full private lender. I'm a full-time hard money lender. I'm not a full-time mastermind group leader. I'm going to base this off of my schedule, my timeline that makes sense to do because I don't want that. I don't want that to be my full-time job personally. I just want to, grow a group around, the needs that we all have.
That's the other big one. Everyone's like, oh, why don't you just go do this? Well, we're not gurus, dude. Like you are not a guru. I'm not a guru. Yes, we have like a lot of experience and can talk about a lot of things and probably industry. I don't want to say experts, but we're way at the top of the industry and like both what we operate in. But in the same sense, it's like, hey man, like we want to discuss what's good for us and we want to do it on our terms and on our time. And the people that we surround ourselves with are also doing deals. They don't want to do group coaching calls every single day. They don't want to, be inconvenienced to do X, Y, and Z. We set it up the way that works for us. And most of the people that hang out with us are similar minded to us and looking for the same type of service. So I agree that, being able to set the group up the way we see fit that helps us learn. We know that it's also help the other people that follow us or that are a part of it learn as well.
So controlling capital has been a really, really hot topic as well. From a lot of people I talk to, I know it's a hot topic for you. It's definitely a hot topic from us. I mean, we've always been in the business of, having control of capital that we lend out over the last 17 years. I don't know how to run a business without it, to be honest with you. I think that's a big, big part. And, I would challenge viewers and listeners, if you don't have control over some of your capital and you're not out there raising private capital every day, you really should be. That's not to be that you shouldn't buy deals with only private capital. I think there's a lot of other good financing options between banks and institutional lenders and hard money lenders and seller financing and things like that. But having some control of capital, your own or somebody else's, is important. And you need access to capital, in order to do these deals, especially in the environment that we're at, where there are going to be some very good discounted properties. There are going to be very good opportunities if you can close quick. There are going to be a lot of good opportunities if you have funding available and can move on it. So I'm excited about that personally. Inside all of our businesses in general, we always look at it as find deals, find capital, find deals, find capital, find deals, find capital. Like there's three components: deals, capital, and kind of the education, the know it all, the execution inside these businesses. But too many real estate investors are out there just humping to find deals, humping, find deals, which is good. Like they should be finding deals. That's probably the most important thing, because I think a good deal attracts capital all day long. And if you don't have a good deal, you're not going to really get capital. And if you are, it's not going to stay around for a long period of time. But at the same time, it's finding deals and raising capital. And, there's a lot of capital sources. There's a lot of there's less liquidity on a macro level, but I believe there's a lot of liquidity on kind of a private micro level, because they're looking to get good rates of return on their capital on conservative assets. And I think real estate investors can bring that to the table. So I don't know another way to, run a lending business, run a real estate investment portfolio without having some access to capital that you can potentially, use with other funding sources to do deals.
Yeah. I mean, I'll give you a prime example. We had 3 properties that we had financed with the bank. Our rate extension hit, or rate readjustment hit. We went from 4.5% to 8.5% amortizing. I mean, that is a big hit to the wallet. And then we're sitting there saying, well, if we're going to pay 8.5% amortizing, we might as well pay 8 to 10% to one of our capital investors and just do it interest only and have a higher cash flow. And, so we're sitting there going, well, who's going to do that? Who's going to do that? But people are still looking, even though, again, I think we've talked about this before, is like, once the banks went from like 0.5% savings to like 5% savings, all of a sudden, all of our investments became validated. People are like, oh, so a 10% rate of return is real, right? Because now the banks all of a sudden are paying 4 or 5%. So we'll be able to go to one of our capital investors and say, hey, why don't you just hold the first position loan on this until rates come back down or we decide to sell it? We're sub 70, we're sub 65%. We're almost 60% LTV on this. You're super safe. A lot would have to happen for the market to come down. So why don't you put the capital in, and we'll pay you just like we would pay the bank. We might as well pay you instead of paying the bank. So I think there's a lot of opportunities like that. I think getting creative, controlling capital is not just controlling your capital investors. It's also controlling, your deal, your capital stack inside your deal, and being able to talk to sellers and talking about it creatively and say, hey, look, I can give you rate, or I can give you term, or I can give you your dollar amount, or I can give you terms. It's one or the other. You're not getting both. I think right now dictating terms is probably maybe more important than price. I think there's a lot of sellers that are willing to get their price, but they are willing to give up a lot of terms to get that price, and forego what it is. I mean, we just negotiated a deal on a piece of property that we'll be bringing to market here soon. The guy took $1 million haircut in exchange to get potentially paid 5 years later. I mean, that is huge.
Yeah.
So I think there's a lot of not just controlling capital from a capital investor standpoint, but controlling capital in the deal and the deal structure.
No doubt. Any questions or comments from everybody tuning in live? I'm glad we're doing this live. There's definitely some good questions, and definitely a popular topic. So it was good that we, pretty time sensitive, because I just got back from one of my mastermind groups. You're pretty active inside your mastermind group. It's interesting to see what's happening in the market with deal flow and capital and things like that. a lot of, one interesting thing I saw, and I don't know how this translates to the whole market, but everyone in our private lending mastermind group that I run, every single one of them had a really bad January, just bad, like a lot, like less deal flow. And then February was like decent, and March was just smoked, like so many transactions. So whatever that was, I don't know, maybe a coincidence, but there's a lot of real estate transactions. I also buy data. For almost, every real estate transaction that occurs, not just locally, but nationally. And there are so many damn real estate transactions. There's so many. There's sellers that want to buy, that want to sell, need to sell. There's just a lot of transactions. That was on the residential side. When I was looking at some CoStar data yesterday, there's so many darn commercial real estate transactions, even with, cap rates being higher, even with interest rates being higher. There's just always transactions. There's always a good time to buy. There's always a good time to sell. So I don't think that should discourage folks. I just don't. I think there's good opportunities. I don't think there's like a ton of blood in the water yet. I think we're kind of all like, hey, we're all in a good position. Like, we're just waiting for really good opportunities to happen. And I think some of those good opportunities might be sitting right in front of you. You just don't realize how good of an opportunity it really is, because maybe you're used to something that, I don't know. Maybe you're just used to something that didn't look like that. So, I mean, that's what opportunities are, right?
Yeah, I think people are adjusting to the pricing. They're adjusting to the debt. I remember, if we can go back a few shows, it's probably been a while since we've done a live one. It's probably 6 months plus, maybe 3 months. I don't know. But I remember talking about this. Is we're all looking for stability in the marketplace. When I called my debt broker the other day, and I'm getting ready to show some underwriting we're doing on a 53 unit apartment building, when we're underwriting it, I called and I was like, man, I think debt's going to be around 6.50 to 7%, 6.5 to 7. I call him up. He's like, yeah, it's 6.75. Cool. Stability. People are starting to recognize, like, hey, this is the expectation of the market. And if it stays high, that's fine. People just need to know what the stabilized number is. They can't go and underwrite a deal and it changes by 100 basis points the next day. Knowing that stability, knowing the market is going to allow that pent-up demand to be released. Sellers might not like the pricing, but buyers are willing to get more active, knowing their cost of capital is 6.75%. They know their cost of capital from investors are whatever, 8% or whatever it is, however they structure it. They know people are willing to do deals. The more stability that's created inside the capital markets, I believe the more availability there will be people to purchase, to buy and sell and transact deals, I think is what we'll see here on out for the rest of the year, whether the Fed moves rates or not.
No doubt.
So
cool. Yeah, that's a good show. I think a lot of good information. If anyone needs anything, any other comments related to this episode or any other episode, feel free to comment below. Like, comment, share this episode. We certainly appreciate it, no matter how you're watching or listening to it. And hey, share it with a friend. If you think somebody can get value from this episode or from any of the episodes we've done on the Real Estate Reserve podcast, we'd certainly appreciate it. Ian and I have this little joke that we pretty much talk every day, even though we're not, our core businesses aren't direct business partners. We each have individual business partners. We are business partners in a lot of creative real estate transactions we've done together, and we chat about this stuff daily. And we have a support system. We have both myself and my partner, Ian and his partner, like, we all communicate, and we have a support system, and keeps us all on the cutting edge of what's going on. So feel free to reach out. If we weren't going to be talking about this, together on the phone, we would be talking about it publicly on this podcast and on this platform. So it's something we enjoy a lot. All right, guys. No other final words from Ian?
No, you summed it up. If you guys got any value out of this, the best compliment you could give us is sharing this, and we will catch you guys on the next one. Back to our regularly scheduled shows.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.